This is Duke University.
From an American point of view, far and away, the number one trend is what's going on with the shale gas reserves. Shale oil as well, but on the shale gas side, we're just seeing supply driving prices down for decades to come, would be the current projection, and just changing everything about the electric utility industry or the electric power industry in the United States for the coming 20 years. In particular, we're seeing coal move down the dispatch curve and displacing coal. Coal starting to retire. We're seeing nuclear plant operators who felt very, very comfortable 5, 6, 7 years ago with wonderfully rich margins under tremendous pressure, and early retirements of nuclear plants as well. So we're seeing a very, very dynamic generation side of things driven by the shale discoveries and all that capacity coming onto the market. We're also seeing continued push on some renewables and some growth on that front. So the whole generation fleet, even though demand is relatively flat, is undergoing tremendous, tremendous change in a turbulent environment. I think the most powerful tool you can use to try and navigate through these turbulent times are the fundamental tools and analysis from microeconomics. If you take a look at cost curves, understand the shifts in the fuel costs around natural gas as a result of the shale supply, as we were talking about. You can see how that plays through on a cost curve, changes who's most competitive, who's least competitive, which asset classes will grow, which ones will retire, and better understand the long-dated implications on the price that the market's going to see over time. I think the changes going on in the U.S. energy sector are going to drive the global economy and wealth creation opportunities fundamentally. I think it's doing a couple things. First, it's driving a lot of investment on the infrastructure side of energy in the United States. With a shift in where we're finding gas, tons of gas there, and a need to move it to the consumption points, there's pipeline investments, there's water purification investments, there's all kinds of things that are tens, even hundreds of billions of dollars in magnitude that are going to be attractive investments to be made in the U.S. In addition to that, it's the change in the energy environment's driving down the energy prices fundamentally in the United States and keeping them down for decades to come. That's pulling manufacturing jobs back to the U.S. It's driving an awful lot of construction jobs in and around the development of the reserves. And we're seeing a resurgence in the U.S. economy in and around some of these traditionally smokestack industries that is going to be a very long run and really drive the competitiveness of the United States. I think we're probably the only country in the world that's moving toward increasing energy independence, even though others have gas reserves and the like as well. We're the ones moving furthest along toward energy independence, even exporting energy over time. The gas reserves are so abundant, we're probably going to see LNG investments in the money. As long as we can get things sited, you'll see exports of LNG. That's tens of billions of dollars of capital that's going to be deployed and attractive again. And then you're going to see secondary type investments that are also lucrative. Things like nuclear plant decommissioning businesses will build. Something that we haven't had in this country before, but if gas prices stay low, nuclear plants will retire as their site licenses were ordained when they were first set up. And that's going to be a very, very complicated and probably lucrative business over time. With so much money going into the infrastructure side and in and around energy, I think policy matters greatly in terms of how quickly and in what form we get at these opportunities. I think there's going to be policy around emissions. There's going to be policy around water purification standards, which are very, very important to the shale gas economics. Probably not enough to change the fundamental attractiveness of shale gas economics, but the way the water standards get set and the like will drive a lot of secondary investments and make them attractive or unattractive based on how they work out. And while I would say it's not formally policy, I think siting remains very, very important. You can't get LNG built if something doesn't get sited. If it doesn't get sited, then all the gas stays here in the U.S., suppressing our gas price at home, making abundant and low-cost supply that doesn't get more extracted and sent to the rest of the world. So siting there, siting on gas transmission lines, and things like that will matter greatly in terms of the investment attractiveness at a specific level going forward. I think technology is also one of the forces shaping the energy sector going forward. There's application of existing technologies like fracking, which is driving the shale gas revolution. It's not a new technology, but it's been refined and it's being applied at a pace it's never been applied at before. So I think that's fundamental. The other area where I think technology is going to matter is on the demand side. We're seeing technologies in lighting, which is one of the major consumers of power in this country, reducing the energy intensity of providing light. I think we're going to see metering technologies continuing to evolve, both in design as well as in application, so that we can get closer to time of day or real-time pricing and begin to bring some price signals and push them onto the consumers who historically have not understood pricing and how their consumption patterns affect pricing. Changing that over time, shaping the load more to the supply side a bit. And that technology, while in existence, has not really been broadly applied. And I think that's going to start changing and put pressure on the industry over time and create a set of opportunities over time as well.